Wraparound Mortgage. New encompassing loan without replacing existing loan. A wraparound mortgage wraps, like a covering, around an existing mortgage. Seller A sells his home to buyer B. Seller A has an existing mortgage of $200,000. Seller A gives buyer B a wraparound mortgage for $400,000. The price of the home is $450,000, so buyer B also puts in $50,000 in cash. Seller A does not pay off the original $200,000 mortgage, but continues to pay the $200,000 original mortgage out of the proceeds of the wraparound mortgage and keeps the balance as his payment for the rest of the price of the home. A wraparound mortgage is a new encompassing loan which does not replace the existing loan, although it covers the cost of the existing loan. Alienation, transferring, conveying, or selling of property. Alienation is the transferring of property from one owner to another. An, quote, alienation clause, end quote, or a, quote, due on sale, end quote, clause is typical within a loan agreement, and it says that if the property is transferred in any way, then the balance of the loan is due. This is important to a loan company because their agreement is with a current owner, not some subsequent owner. Parentheses, a loan assumption clause has been a part of loans in the past, but it is not currently common, end parentheses. Alienation is another word for selling, transferring, or giving a property from one owner to another. Synonyms: transfer, convey. Related words: convey, transfer, due on sale clause, acceleration clause. Warranty deed. Old form of deed used to warranty transfer of clear title. As might be imagined, the troubles of trust in transfer when it comes to real property are not new. Before grant deeds, trust deeds, and especially before title insurance, there was the warranty deed. Much like the grant deed, the warranty deed warrants the grantor's right to transfer title and that the title be free of any non-disclosed encumbrances. The warranty deed is no longer used in California. The grant deed further warrants that any subsequent title rights will also be transferred to the grantee. Title insurance is very successful at guaranteeing title transfer, and therefore the warranty deed is no longer used. Related words: title insurance. Corporation Code. State rules regulating businesses, brokerages. The Corporation Code is the state body of rules which regulate businesses in California. Real estate businesses or brokerages, which are businesses run by real estate brokers, parentheses, people with a broker's license, end parentheses, fall under the jurisdiction of the Corporation Code. Associate licensees must be registered under an employing broker, and therefore associate licensees work under the Corporation Code also. The Corporation Code is the set of state rules which regulate businesses, which includes brokerages. Servient tenement, property that bears the burden of an easement. There are two types of tenements: servient tenement and dominant tenement. The dominant tenement is the property that enjoys the benefit from an easement. The servient tenement bears the burden of an easement. Imagine a piece of property locked in by land. An easement across an adjoining property solves the problem by allowing the owner to get to the property. The property that has the entryway easement, say a driveway, built across it bears the burden of the easement and is the servient tenement. and the property that was landlocked enjoys the benefits from the easement and is therefore the dominant tenement. Antonyms: dominant tenement. Department of Alcoholic Beverage Control, ABC. Regulator of liquor licenses. The Department of Alcoholic Beverage Control, or ABC, regulates liquor licenses in the state of California. The ABC manages initial applications for such licenses and the transfer of liquor licenses with the sale of a business. Those with criminal records cannot obtain a liquor license. The resale of a new (less than 2 years old) liquor license is limited to $12,000. Applications for a new liquor license or the transfer of a liquor license requires postings on the actual property and publishing of intent to sell liquor in local publications. Additionally, applications can only be approved in areas of cities approved for such use according to local zoning. Typically, commercial zoning is required to apply for a liquor license. The Department of Alcoholic Beverage Control, ABC, regulates liquor licenses. Related words: liquor license, bulk sales. Fructus industrialis, crops produced intentionally to sell. Emblements and Fructus industrialis are synonyms in that they are crops which are intentionally grown by human labor to be sold. The opposite of Fructus industrialis is Fructus naturalis, which are crops or vegetation growing naturally or without human labor and not for the intention of being sold. Here is a story. Mr. Farmer rents a plot of real property to grow orange trees so he can sell the oranges at market. The oranges are emblements or Fructus industrialis. The orange trees are real property because they are attached to the land, and so are the oranges until they are picked. Once the oranges are picked, they are personal property. Picked or not, the oranges are Fructus industrialis or emblements. If the oranges were growing naturally, they would be called Fructus naturalis. Fructus industrialis is the name of crops grown on real property for the purpose of being sold. Preliminary Title Report. Investigation of title upon which insurance is offered. A preliminary title report is a report prepared by a title insurance company asserting that a property is owned by the person who says he owns it and that person has the right to sell the property. Additionally, the preliminary title report will detail any found restrictions on the sale of the property, like mortgages, liens, or pending court cases. Based on the preliminary title report, title insurance will be offered at a price for a limited time. A preliminary title report is an investigation of a real property title by a title insurance company, which then allows the title insurance company to offer a title insurance policy at a set price for a limited time. Related words: title insurance. Procuring cause: broker who produces a ready, willing, and able buyer. Procuring cause is the test of who is responsible and therefore possibly owed a commission for a real property sale. Procuring cause has been achieved if a ready, willing, and able buyer is produced, and additionally, who wrote the winning offer and presented it to the seller. Depending on the listing type, if the price and terms of the seller are met by the offer, then a commission is owed to the procuring cause (the broker), whether the seller accepts the offer or not. A listing is an agreement between a seller and a broker to sell real property, and the types include exclusive authorization/right to sell listing, exclusive agency listing, open listing, net listing, and option listing. The exclusive authorization/right to sell listing requires the owner to pay a commission to the broker regardless of who is the procuring cause of the sale. An exclusive agency listing is a listing agreement where a commission is paid only if the broker is the procuring cause. No commission is due if the owner sells the property himself. The procuring cause is the one who brings a ready, willing, and able buyer, and basically means the broker who writes up the winning purchase contract and delivers it to the seller. Related words: listing agreement, exclusive authorization/right to sell listing, exclusive agency listing, open listing, net listing, option listing. Fully amortized loan. Loan with payments that pay off the total loan balance. A fully amortized loan is a loan that fully pays off the loan balance by the end of the loan term. A partially amortized loan is therefore a loan which does not fully pay off the loan balance by the end of the loan term. An interest-only loan pays none of the loan balance. Both a partially amortized loan and an interest-only loan require a balloon payment at the end of the term to pay the remaining unpaid balance. Why take a partially amortized loan? Because of the lower monthly payments. Such a loan is taken short-term to maximize cash flow with the intent of refinancing or replacing the loan later. Construction loans are typically partially amortized loans or interest-only loans and are set to be replaced with a takeout loan after the building is built or project completed. Takeout loans are so named because they, quote, take out, end quote, or replace the short-term financing. A fully amortized loan will be repaid in full by the end of the loan term. Antonyms: partially amortized loan, interest-only loan. Related words: balloon payment, takeout loan.